Hello everyone in this fine hour. Now we will continue our thread and explore foreign currency markets, or of course Forex. Now in previous videos I have explored good markets and not so good markets, and now I will show you a market which is a bad market for trading and simply one is not worth it. As I said in, for instance, previous video against Japanese yen, I told you that there is some money making opportunities, but they are just not worth it. But still, you could trade. There are some arguments for this market. But for instance, markets like Euro against British Pound are simply almost non-tradable. Why? Well, let me show you. For instance, this is a long-term chart from mid-70s till today, so we are having good grasp of what this market is about. Now, of course, before late 90s, when Euro adopted, this was Deutsche Mark, so all charts are Deutsche Mark against Euro. Excuse me, Deutsche Mark against Pound. Now let's continue this thread and let's see what's going on. And here is the problem. Although on the surface magnitude and trades itself seems like alright, they have uptrends, downtrends and everything is fine, but if you see actual magnitude, it's very small. Yes, there are trends, but those trends are so small that for other markets it could be on several times smaller time frames. For instance, even in the mid-70s, structural trends went from 0.56 to 0.76 and then back again to 0.51. Like, these trends are, I don't know, daily trends in other British pound pairs, so even if there would be some money made, they were just actually too small. And then let's see, for instance, last decades from 80s till 99, overall these moves are like what, from 63 to 0.56 and so on and so on. It fluctuates in very small numbers. If it rises a bit and then reverses, stays flat for several weeks, and then also rises in very small increments again. Like these, you could trade the market for 20 years and there wouldn't be many profit opportunities. And even in those two large trends from 96 till 99 and then up until 2007 till 2009, those magnitudes were from 0.87 till 0.58 and then from 0.68 to 0.95. So these are like nothing for weekly charts. These are nothing, no trades. And this is like what, 2007, 2008, when other currency markets made a fortune. If you traded same pound against any other market like yen, Australian dollar, United States dollar, whatever, you could have the same trends and make several times larger trends. So there is that. And even then, when we had the Brexit and COVID, like the markets did nothing, and actually since 2009 you had like two half trends for weekly charts, so that's nothing. That's non-tradable trend, and I will just show you that in shorter time frame. You could see that actually there is nothing much to do. You know, this is like 21. If you have seen any trend, okay, one small trend in late 2021, and then it's very difficult to make money on this small trend. Maybe like it will make money out of, it will make back a couple of losses, but still there is nothing. Then in late 19 there was like one. Now these wouldn't be very good transactions. Okay, 1, 2, 3 good trends in a row for 3 years. You had 3, okay, maybe 4 profitable trends out of how many? Out of many. So it's not worth it. And why it's not worth it? Because the markets are structured in a way that there are same, you know, Euro and pound are European Union's and Great Britain's currencies, and those economies are very integrated within each other's. Now they are largest trading partners. They have kind of similar economic structures, monetary policies, and other things in together, so they kind of cancel each other out. And you could see the same pattern, for instance, against euro against Swiss franc. If I would show you a long-term chart here, in one time in eurozone crisis is like example out of this norm, but other than that, the markets are the same. They are essentially flat. Euro against Swiss franc is not a good market to trade, the same as euro against pound. Why? Because these economies are almost on the same structure, and same is about in Australian dollar against New Zealand dollar. You could see that those economies are quite similar, have large trading ties between each other, and they simply didn't produce any meaningful trends. And that's why here's the lesson: if markets are structured very similarly in foreign exchange, you shouldn't go for conventional trading, like trying to find trends and make moves on market swings. There are better markets for that, and you should just avoid these markets. Now if you're trading in something like monetary policy interventions, as it was with Swiss central bank a couple of years ago, or some carry trades or something similar like that, maybe there are options, but in conventional trading they don't trade markets which are structured similarly, because as I showed you with this example, this is not a good market. And maybe I will show you a couple of other markets to prove my point. But I hope you get the lesson. Make sure you're following me, and bye.